And what's up, everybody? Joined today by Christian Gurrola. Christian asked me yesterday, sent me a text. Christian's over at Modern Dwellings in Riverside, California. You probably see a lot more of his content than you see of mine. He's done a much better job than I have of getting out there and shooting some really cool stuff. I love your local spotlight stuff that you do, man. Both for real estate and for small businesses. I'm sure they're hitting you up all the time.
That seems to be the only thing that actually does well is the food.
Well, it's interesting because people go, "Oh man, that place is open," or "That place changed ownership," or ribs look good. Where's he at?
And in the hate comments is the best thing.
Well, if you don't have haters, man, you're not doing it right. That's what somebody like Stephen A. Smith says that. I think somebody like that, somebody that's making more money than I am.
Oh, it's true. You got haters, and you're getting enough exposure to be having those haters come in. So
that's right. That's right.
No such thing as marketing, right?
That's right. That is true. But your text, the text that I got from you, literally probably got 12 identical texts. Oh. And so, everybody kind of wants to know what's going on with the market. If you watch the news, all they talk about is how much better the rates are getting.
Yep.
Which is true. And so I know you thought, hey, let's just jump on a call, do something a little bit informal, record something, and then cut this up and show consumers kind of what's going on a little bit behind the curtain.
Exactly. So, there's no better person to do that than you.
Cool, man. Appreciate that. So I figure if you want, man, we can just jump right in. I have this screen share thing kind of teed up for us.
All right, let's dive right into it.
And so basically what we're looking at is, and I'm just looking at the same thing you are, is a 6.5% coupon currently priced at 101.95. This 1 BP in red means that we're down 1 basis point on the day so far. And so this is a huge economic week. We've had like 3 of them back to back. And essentially what's caused rates to come back down from the peaks that we saw just about 30 to 45 days ago and kind of went through for a whole month is that the overall inflationary numbers, the way the Fed looks at them, is lower, right? They've come out. They originally stated their target was 4%, then it was 3.5% of inflationary percentage, and now it's 2%. And now, if you really interpolate the data, we're pretty much where the Fed stated they wanted to get.
Yeah.
With their most conservative statement on that. And so what we saw was we just saw markets rally for the last 2 weeks, and probably some of the largest improvements that we've seen in a while. But one thing like mortgage rates, a lot of times people think, oh man, we had like an 80 basis points improvement today. That means the rates got just so much better. Not true, because the way mortgage companies set their rate sheets is that they've already bought coverage when it was worse, right? A lot of times.
Priced in for those people. Yep.
Right. So what that usually translates to is that marked improvement, we really don't see that for a couple of weeks after that stuff happens. And for 2 reasons. One is whoever is running the secondary marketing departments for any mortgage company is looking at things like, is this run going to last? Is it going to get so much better if I buy coverage now that it's going to be bad in 3 weeks? The position I'm in right now. So some of it is wait and see. Some of it is, we still have to fill this other coverage, where if we drop the rates dramatically, we're not really going to make any money on the small hedge or the hedge that they're running, right? So there's so many different facets to the mortgage business. And the point is, it doesn't always translate directly to the street immediately. But really what we've seen this week is a lot of direct translation to the street. And so I teed this up because I want to show you, a question that we get a lot. And I know a question that you want to know is, where are rates heading, right?
Yep.
And if we look at this, this is kind of where we've been since October 16th.
Yep.
And you can see we kind of bottomed out way down here at 98.54.
Yep.
Literally, we've improved by almost 400 basis points since then, right? Or that's where we're heading. So what we've created is this channel, right? So this bottoming created kind of this bottom, and we can now touch 3 candles to that channel, which is held. And so you can see the upward trajectory on this chart. The higher this number gets, over 100, the better rates get.
Yep.
And they're getting so good that we're probably going to kick back down into the 6% coupon. When rates were in the 2s and 3s, we were in the 3.5% coupon, which tells you how far we've come since then, right? And so these channels have become pretty well identified over the last 30, 45 days. And you can see that the trajectory is rates are going to improve. The second thing that people look at is the 10-year Treasury. And you can see we touched 5% on October 23rd here, right?
Yep.
And we're all the way back down today, trading at 4.1623.
Which is great.
Exactly. And both of these charts will show you like different levels of resistance, right? And what we see is that levels of resistance kind of become, the ceiling becomes the floor, right?
Mm-hmm.
And so if we look back at this coupon here, what's happened is this black line here is the 50-day moving average.
Yep.
This purple line, the 100-day. This red line is the 25-day.
Mm-hmm.
And this is the most important one right here, the 200-day moving average. We blew right past that on December 1st,
yep.
which was great because what's happening now, you can see how many times these candles have touched that
Mm-hmm.
level. This was the ceiling. It's now the floor, right? And so that upward trajectory channel, that's an indication that it's going to continue improving so long as the economic data that comes out is good. And this week we got a lot of data. The inflation report was a little bit off, mostly due to used car sales, believe it or not.
Mm-hmm.
And so, as you know, if you tried to buy a truck in the last 2 years, they really haven't gotten much more affordable today than they were a year and a half, 2 years ago, right? Probably about the same. And so for that reason, that's kind of holding inflation above the technical average that the Fed wants to see.
Yeah.
Today, the came out, the producer price index came out, and that was favorable to bonds. But what happens is, like, when I logged in this morning early, like 6:30, this was up 17 basis points.
Mm-hmm.
And you can see now we're already down, to up 1 basis point. And that's what it's been doing all day. And that's because in just an hour at 11:30 Pacific Standard Time, the Fed is going to have their press conference, right?
Mm-hmm.
So they've been having a 2-day meeting. And what happens is after these guys come out of their 2-day meeting, Jerome Powell, the Fed chair, always does a press conference. And that either is super awesome for the bond market or it really sucks for the bond market, So it's kind of funny how with all this stuff supposed to be based on data, but it still comes down to one man behind a mic giving an opinion that either throws the markets into a tailspin or cranks them up. Right.
Yeah. That's crazy. One man, what he says kind of dictates the entire market for either a few hours, a few days.
Yeah, what you see is just like knee-jerk reaction. And it might take a week to recover from that. It might take a day to recover from that. It might take 2 hours to recover from that because what's been happening is instead of people just going off of headline news, they actually start interpolating the data. And they say, well, based on what his comments were, he's actually wrong. So maybe he'll realize that he's wrong. And news was actually positive for the bond market.
Yeah.
So this is all positive news. And a question that a lot of people have, let me see here. Stop sharing. Let me do another. So as you know, anybody that we work with gets the same type of an analysis. This is for somebody with excellent credit, which what I'm noticing right now, and I don't know if you guys are doing the same thing, is the buyers that are in the market right now are really well qualified and they're super serious, right?
Yeah.
And I think, with all this talk of where rates are heading, you and I both know what's about to happen, right?
Yeah.
I mean, do you see inventory getting a whole lot better in the next 60 to 90 days?
No, and that's a big issue in its own. Is I have so many buyers coming out just from this past week, and hey, I heard rates are getting better. What are things looking like? Well, okay, let's dive into it. But the issue is right now is inventory is so low. I mean, I can't tell you the amount of showings that I've been on in the last month, pretty much working 30 days straight and not even writing an offer just because people don't like what's out there right now.
Yeah.
So it's one of those issues where we have a lot of buyers, and now it's going to be an entire wave of buyers. So I'm hoping what that does is it gives us realtors, us professionals, us advisors an opportunity to kind of fix that market. Hey, sellers, this is where we're at. It's another opportunity for you guys to take hold of your equity with all these buyers coming out right now. So I'm hoping after the wintertime just on average is kind of a historically low in terms of inventory and a little bit slower season. So I think it is going to pick up this spring for both the sellers and the buyers.
Yeah. And buyers, like, the thing that worries me is that, let's say rates continue on the trend here, downward. For every 1% that the rates improve, 8 million more eligible buyers enter the market on a national level.
Yeah. And it's scary. Is it going to be like one of those COVID 2.0s where we had 30, 40 offers on properties?
Right.
Obviously, I don't think it'll be to that extent, but it'll be a lot tougher.
Yeah. And the advice that I've been giving the buyers I've talked to, or anybody I've talked to in the last really 45 days, is if you can afford it now, do it, because you're still getting concessions. You get a $15,000 concession on a property and, completely update, 2 bathrooms with that, or 1 bathroom. You know what I mean? Like,
Exactly.
you have to kind of start thinking like that. I think if you're a buyer, if it were me, I would definitely be executing now, so long as I can afford it.
Yeah.
I think there's a lot of people that look at it and they go, hey man, I just can't afford it. And that's okay, right? That's okay. There's still going to be opportunities for you as well. But if you're the type of buyer that can't afford it, I think you have to execute now. And I'm not just saying that because I do loans and you do real estate.
Yep.
It's just, I know we were in the COVID market, man. 20, 30, 40, 50 grand over asking for the right property, right? Yeah. No appraisal contingency, no inspections. I mean, basically like this, right?
No security for any buyers at all. They don't even know
right.
And they're just throwing money at
it. I mean, you're totally as a buyer in a market like that. And I hope that's not what happens. I have a feeling a lot of that will happen. And to show as like a direct translation of what this looks like, this is priced with somebody for a 740 credit score. I know if you're like me, you like to see real numbers. And so I realize everybody doesn't have a credit score. So best practice here, guys, is to reach out to Christian or I and get your own custom analysis based on your specific targets and goals and criteria, because the pricing can change pretty drastically depending on what you have going on. But I mean, dude, government stuff, Christian, we were at 599 3 days ago. We're at 5749 right now.
Yeah.
Conventional minimum down, we're at 6799. All of this is with a 1 point cost. So these are not par rates. So par rates, Govy stuff, you're just below 6 or right at 6. And on the conventional stuff, you're, touching 7, whereas some people were over 8%,
which is fantastic. Yeah, where we were at a month ago. And that's one of those things too, where I'm trying to tell buyers right now, hey, I think I want to wait for, interest rates just to drop a little bit and prices to drop just a little bit. And what I try to portray and make them see is like, is it for you to wait and try to time the market for a potential savings of a couple $100 a month? Is that worth it? It's one of those things where a lot of people have to think about, and they really don't see that.
Right. Or, what I've noticed is some people don't have like a lot of vision, where, I know you kind of grew up around flips and remodels and you've seen all that stuff like in real time happening, and so I think that a lot of buyers can be really served extremely well by maybe looking at some renovation products now. Those programs carry higher interest rates, but we all know you're going to be refinancing in a year to 2 years anyway.
Exactly.
I mean, realistically, if we just look at the data, that's not, my opinion. If you just look at the data, the rates are going to continue to trend down, right?
Exactly.
Barring some sort of, natural disaster that, I think if rates got back to the peak where they were at, I mean, something really wild would have to happen.
And it's an election year, so it's pretty much guaranteed.
That, and, it's kind of weird, like in our chairs, it's not like we root for bad news, but usually when we hear bad news for the economy or bad news globally, it's good news for mortgage rates. And so if something really did hit the fan, like you can see all the tension in the Middle East and all that stuff. Even Ukraine, and I mean, globally, there's so much going on. If any of that stuff got even hotter, then that would also, improve things here, because they would be trying to spur activity, right?
Yeah.
So yeah, I think advice, man, if you can afford to buy now, it's a great time to buy. I think for some sellers, at least my opinion is, I know I wouldn't be quite there. If I saw something I really liked, I'd be like, man, am I gonna trade my 2.7 for
Yeah.
5.7? Maybe. I mean, a lot would have to be going on, or a lot would have to be going right. But I think if we get even a half a point better, or 3/4 of a point better,
Yeah.
you know,
Might be an opportunity for people to actually think about it. So
yeah, man. I mean, working with a mortgage broker, I think we could see rates, dip into the high fours.
Yeah.
Because I don't think what we talked about here today, I don't think that run is going to stop anytime soon. I think the unemployment numbers that are coming out, and the 3 backward revisions that we've had with employment figures, it's just indicative of kind of what's come for 2024, I think.
Yeah. Yeah.
Cool.
Exactly. It'll hammer on the nail.
Do you have any what would you say your biggest fear is right now for home buyers in this market?
My biggest fear, it's not my fear for myself, but for home buyers, what they're telling me is all of them are afraid of a complete crash. If they do purchase right now, 3 to 5 years, they're afraid of upside down on their property. So it's one of those things where I say, hey, historically speaking, you look at all the charts, at the data. I mean, all the data. I went to school for finance, so I'm a little bit of a data nerd and analytical wise. I say, hey, we look at all this stuff historically speaking. I mean, you're in this for the long run. I mean, this is an investment at the end of the day. It's not something that you're going to buy and then purchase and then just sell within 3 to 5 years. I mean, you have to really think about this, holding it for quite a long time to create financial wealth for yourself. So you might have a little bit of a plateau. You might be a little bit upside down in a year, but it's nothing to really fear, because, I mean, it's happened to everybody. My mom and dad bought their first house in 2006 for $600,000, which was egregious and an outrageous amount of money for at that time. And then we all know what happened those following years.
Yeah.
Now that property that they live in is worth well over $950,000.
Right.
So it's one of those things where, historically speaking, I mean, it might go a little bit up and down, but there's a gradual climb up that hill at the end of the day.
And I think that's just it. Like we have a report too, so anytime you need this, we can generate it for you. But it just shows a standard 4 to 5% year-over-year appreciation. And even if you were to get out, what it shows you is after year 2, you can get out of most properties if that 4 to 5% year-over-year appreciation continues, which that's the historical trend.
Yes.
And you could still make 20 grand over what your payments were, over what your cost to sell was, all that stuff.
Yeah.
But yeah, if you look at history, and you gave a perfect example, because your parents weren't just underwater, they were buried.
Yeah.
Everybody was, which is why it comes down to affordability, right? Because they still needed a place to live. They needed a place to raise you guys, right? And the last thing they're going to do is disrupt the family unit because, oh, my value fell. And I think a lot of people have that mental disconnect. It's like, you still need a place to live. And for anyone who's lived through, 04 to 2011, 2012, really, you've seen the extreme swing in property equity. And if you look at that appreciation line, it's still 5% year over year, even with that massive swing, when we had the economic collapse, basically.
Yeah.
And so I think, you're still going to need a place to live, and if your value tanks, I think it's a valid concern for buyers, but I think it's one that they don't necessarily, they're not looking at all of the data to make a non-emotional call on that. Right.
Yeah.
So yeah. Cool, man. I'm seeing the same thing. And I never used to have to run that deep of an analysis, like the last 5 years. It's just, hey, here's what everything looks like. Great. Let's go.
Yeah.
And now I've noticed same thing. It's just, but it's not, I think the people that are trying to sell people right now are doing them a disservice. But if you're able to present the data in a format that makes sense, then you're actually trying to help them,
Yeah.
because either they can afford to do it or they can't. And if they
Yeah.
can't, they shouldn't be doing it,
Yeah. At the end of the day, too, I mean, people have to see the numbers. They have to see what they're getting into, and they have to know that, and they have to be well advised by, people like yourself and, myself and my team that, hey, this does make sense, or sometimes, hey, this won't make sense.
Right.
It's one of those things where we have to be, completely transparent and, try to make it make sense for them. Like visually speaking, like you do a job laying out that format on Mortgage Coach where you have different types of loan options, different types of scenarios where, okay, I think I can do that. And then with the appreciation, the 5-year, year over year, like you said, the 5%. So it's one of those things where it just takes a really good person to be an educator at the end of the day.
Yeah.
And I think that's what the job is about.
Yep. I agree, man. I agree. Well, keep killing it, man. You're doing a great job, dude. Anything else you want to talk about?
No, buyers seize the opportunity, seize the day. That's it. If it makes sense, let's get it done.
Yeah. And if you need solid advice, hit us up, guys.
Exactly. All right, Joe.
See ya.
Appreciate it. Take care.